Today, let's talk about this REIT stock that has beaten not just Nasdaq and S&P 500, but also Warren Buffett's Berkshire Hathaway by 1.5 to 2 times since it went IPO 25 years ago. Its properties are in such high demand that its 10-year average occupancy rate has reached 96%. It also benefits from the long-term tailwind in the life science and biotech industries. The REIT is Alexandria Real Estate Equities, ticker ARE. ARE owns, operates, and develops collaborative campuses for life science companies, basically properties that serve as their headquarters and research and development centers. It was founded in 1994, and it was the first real estate company uniquely focused on the life science industry. Today, it generates $2.6 billion in revenue with a $25 billion market cap. It operates 432 properties across the nation's top innovation hubs. There are 4 key reasons why I like ARE and would own the stock for the long term. Number 1, ARE has strong competitive advantage. This is anchored by their business model of building mega campuses in innovation clusters for life science tenants. Number 2, there is an outsized demand for ARE's high-quality properties in prime locations, therefore giving the company significant pricing power. Number 3, ARE has a diverse and high-quality customer base of 1,000 tenants who are sticky and loyal to the company. And number 4, ARE has delivered consistent top-line growth, profit margin, and increasing dividend, and it has a visible development pipeline that supports future growth. Let's dive in. ARE's properties are remote work proof. Although remote work has dramatically reduced demand for office space in the past 4 years, that is not the case at all for ARE. Its life science tenants, including COVID vaccine maker Moderna and Pfizer, rely heavily on in-person collaboration in labs in order to conduct their research and development work. The differentiation cannot be clearer when you look at ARE's occupancy rate versus other office REITs in the past 4 years. While office REIT's occupancy rate declined from 93% during pre-pandemic to 88% in 2022, ARE's occupancy rate stood firm at around 95% during the pandemic and afterwards. ARE's success was not pure luck. It originates from its strategic focus on the so-called cluster model. In plain language, it means companies in the same industry and same ecosystem can benefit from being physically close to each other. To see how it works for ARE, let's take a look at an example of drug makers such as Pfizer, Moderna, Eli Lilly, who are all ARE's tenants. ARE's Boston campus is adjacent to MIT and Harvard universities and home to 40-plus tenants, including drug maker Moderna. Developing new drugs is a complex process. It starts with groundbreaking theories by PhDs and professors. And to turn these theories into viable products, drug makers need to go through years of clinical trials to get FDA approvals. And they need to recruit specialized talents to do that. Therefore, they benefit from being close to top research universities like Harvard and MIT. Then it comes to lab work, which requires specific customized equipment and materials from a wide range of suppliers. In some cases, the process is so complex that drug makers will co-develop new drugs with specialized labs. Then the drugs need to go through rounds of clinical trials in medical centers and hospitals. The whole process requires these players to collaborate and communicate constantly so that they can accelerate the process by being next to each other. Last but not least, the development process is capital intensive, which is usually funded by investors like venture capital firms and PE firms. They love being close to where innovations are happening in order to identify the best opportunities. And there you have it, the whole life science ecosystem, and ARE's properties provides the critical space to knit together these players so that they can come together and drive innovations effectively and efficiently. There are several key attributes that define ARE's campuses. The first is location. We already touched on how the campuses are located close to innovation centers such as universities and research institutions. In addition, many of them are located in urban centers and economic centers that tend to attract talents and capital, such as Boston, New York, San Francisco, San Diego, Seattle, etc. The second attribute is scale. As the name megacampus suggests, these campuses are big. They all have 1 million or more rentable square feet, and therefore they have the ability to host the whole ecosystem that allows the tenants to thrive, and also space when the tenants need to grow and expand. The third attribute is specialized and complex infrastructure. Life science research and experiments all happen in labs, and these labs need enhanced infrastructure to run. So ARE's properties are built with re-enhanced concrete floors, high ceilings, and equipped with heavy-duty HVAC systems, as well as enhanced environmental control and plumbing systems. Lastly, ARE's buildings are design and amenity-rich. Their buildings all look like a modern art museum from the outside, with distinct architecture, and a luxury hotel from the inside. You can even find gyms and farm-to-table restaurants within the buildings. All these are meant to help their tenants to recruit and retain top talents by providing a workplace that they love. Let's move on to reason number two, outsized demand and pricing power. ARE's properties are very popular due to its high quality and prime location. This is not easy for competitors to replicate. A new entrant needs to first secure space in densely populated city centers that also happen to be close to innovation hubs. Then it needs to have the expertise to build properties that can suit the specific needs of life science companies. And then it needs to have the relationships in order to fill up their buildings. And so, in short, there are high barriers to entry for new landlords. In addition, there are also high barriers to exit for existing tenants. Tenants typically put in significant investment in their labs in order to meet strict FDA requirements for clinical trial of drugs and others. The cost of switching to a new location is very high. Now, these factors show up in ARE's occupancy rate. Their average occupancy rate over the past decade stands at 96%. Most recently, it's 95% across its major clusters. High demand and short supply results in significant pricing power for ARE. For example, take a look at their rental rate increase for lease renewals in the past 7 years. Even before the pandemic, annual growth stood between 24 to 32%. During the pandemic, this rate has shot up to 38% because of the heightened focus on life science and healthcare. The rent increase has normalized to 31% in 2022, but management still expects the strong growth to continue in 2023. In addition, ARES is able to build in very favorable terms in their leases. For example, 96% of their leases include automatic annual increase in rental payment, and 93% of their leases are triple net, which means tenants are responsible of paying for expenses like insurance, taxes, and maintenance, which means more of the rental payment would drop directly to ARE's bottom line. Let's shift gear to reason number three, diverse, high quality, and sticky tenants. ARE serves 1,000 tenants across the life science ecosystem, including pharmaceutical companies such as Moderna, Eli Lilly, and Pfizer, as well as biotech companies such as Novartis and Amgen, as well as institutions including MIT, Harvard, Boston Children's Hospital, and the United States government. Although AIE counts the biggest names in the life science as their tenants, they have a relatively low revenue concentration. For example, their top 20 tenants only account for less than 31% of their annual rental revenue. ARE's high-quality tenants are at the forefront of life science innovations. As a proof point, since 2017, almost half of the FDA novel therapy approvals were granted to ARE tenants, and they are well positioned to receive future investment. People talk about the death of VC investments in 2022, but that's not the case at all for life science industry. In fact, $58 billion of venture capital went into life science space in 2022, the second highest in history. Among these VC investments, more than 70% went to an ARE cluster. In the same year, life science VCs raised around 160 billion of fresh money, a record year, even higher than 2021. Life science companies like ARE's Tenants are well positioned to benefit from this significant dry powder in the VC industry. Of course, life science innovations involve risk, but the good news is many of ARE's tenants are financially sound. Many of them have investment-grade credit ratings, and many of them are large-cap companies, which means it's less likely that they would default on rent payments. To put it in perspective, almost half of ARE's rental revenue came from investment-grade and large-cap tenants, and ARE's tenants tend to stay with the company in the long term. On average, they have 7 years left in their leases with ARE, and more than 80% of the tenants continue to lease space from ARE year over year over the past 5 years. Bottom line, ARE's high quality and sticky tenant base results in long duration and stable cash flows for the company. Reason number 4, financial track record with visible growth drivers. In the past 5 years, ARE grew its revenue at the rate of 18% annually on average. Adjusted funds from operations grew even faster at a rate of 20% annually. It was also able to maintain a stable operating margin between 70% to 72% over the same period. The strong operating results and cash flow allow ARE to grow its dividends. Over the past 5 years, ARE increased its dividend per share by 6.5% annually on average, with a decent dividend yield of 3.3%. ARE has a visible path to continue its growth trajectory, given its robust project pipeline. The company says that its current and near-term development projects are expected to generate $655 million of incremental net operating income in the next 3 years, which accounted for 37% of NOI for 2022. This estimate is backed by the fact that 72% of the new space coming online in the near term is already rented out. In fact, ARE is very disciplined about taking on new development projects. It typically won't start one unless they secure significant lease commitment. So this strategy helps de-risk new projects and provide visible growth. Lastly, ARE has a strong balance sheet to help fund its future growth. Its investment-grade ratings allow it to raise debt capital at a reasonable cost. It also has $5.3 billion of liquidity ready to go to fund new development projects and acquisitions. So to summarize, the top 4 reasons to buy and own ARE stocks include strong competitive advantage, outsized demand and pricing power, diverse, high-quality and sticky tenants, as well as financial track record with visible growth. Naturally, the next question is when to buy the stock. To answer this question, let's first take a look at ARE's stock performance in the past 5 years. The stock grew healthily during the 2 years before the pandemic between 2019 and early 2020. After a brief dip along with the broader market in March 2020, the stock shot up 81% to reach its peak by the end of 2021. Not surprising because of the focus on healthcare and life science during the pandemic. However, 2022 was a tough year for ARE stock. As of March 2023, ARE has lost 37% of its value since its peak, underperforming the market. However, in my opinion, the sharp decline was not really justified because ARE was unfairly impacted by the negative sentiments around office REITs and the talk about VC investments drying up. Now, we already discussed earlier how ARE is remote work proof and VC funding for life science industry is better than ever. The bright side is this creates a good entry opportunity for long-term investors to buy the stock. And the stock seems to be reasonably valued. It's currently trading at 20 times on the forward price to AFFO level, which is 2 times below its 10-year average level and 5.6 times below its 5-year average level. To sense check, let's take a look at what Wall Street analysts say about the stock. In terms of ratings, 10 out of the 11 analysts covering the stock said it's a buy. Nobody said it's a sell. In terms of target price, the median target price is at $180, which represents around 25% upside from the current share price of $144. So what's the entry point? As a reminder, stock prices change all the time, so make sure you do your own due diligence before taking any actions. Now, first of all, you have analyst target price at $180, a recent high of $171. 10-year average valuation implies a share price of $157, and a recent low of $129 provides sort of a floor. So all in, I would be comfortable buying the stock at $160 or below to be conservative. That's a wrap for ARE. Please don't forget to subscribe to my YouTube channel SafeSy for more stock analysis and ideas.